producer. So if you don't want to be recorded, get off now. All right, so I see a lot of familiar faces, and welcome the new people that I am not familiar with. So that would be Mike, Andrew, and Vonda. Everybody else has sort of heard me speak. Let me tell you why this title to me is so important. This month celebrates my 2-year anniversary of giving up my federal registration as a registered rep and a stockbroker. And I am so thrilled. I am now out of the clutches and responsibility of FINRA, the SEC, et cetera, et cetera. So having said that, one of the things that led me to the conclusion that I wanted to give up my registration is the limiting opportunity I had in sharing how wealth works. I'll give you an example. A fiduciary, which several people are touting themselves on, I'm a fiduciary, you're not, so therefore I'm better than you, really only has to discuss as a fiduciary the fee and the commission and the ongoing expense. They sure as heck don't have to and do their darndest to avoid what we're going to talk about today, the taxation issue. And I am not a CPA. I'm not an accountant. I hold a degree in business administration and in life insurance, but I am not a tax preparer. And there are people who will hide behind the name of their title and say, I'm not authorized to talk about that. Go see your tax preparer. Tax preparers don't understand how wealth works. Tax preparers do their darndest to lower your current income tax bill. We at the Breakaway League strive on lowering your lifetime tax bill. I would think most people, when they get close to retirement, want to achieve two things. They want to be debt-free, so therefore they infer that to mean I should pay my home off and I should have all of my money in a deferred plan because I saved taxes. I was told by the fiduciary that if I put $10,000 in a qualified account, I would be saving taxes. So let me be very clear here. When you contribute to a tax qualified savings account, whether it's an IRA, 401k, 403b, 457, Simple SEP, SAR-SEP pension, or profit sharing plan, you are not saving taxes, you are postponing them. Let me rephrase what I mean. You are not lowering your tax bill. You are simply agreeing to pay less temporarily. You will not avoid paying that tax. So when I ask a client 3 questions, do you want to make more every year you are in business? The answer is usually yes. If I ask them on the day that they retire, would they like to remain in the world that they're accustomed to, therefore living the same lifestyle that they were in up to and including their date of retirement? Most people still say yes. And then I ask the most important question, do you believe over your lifetime that personal income tax rates with a $30 trillion debt have got to go up? And that's an emphatic yes. So let me explain by saying yes to those 3 things. I want to make more. I want to retire at that level of success that I've achieved. And I believe income tax rates are going to go up. Today represents the lowest income tax bracket of the rest of your life. Not just temporarily, the rest of your life. And shame on us if we should actually succeed in life. Having an overfunded 401k plan means you could be giving back $272,000 of your Social Security, simply because the withdrawal amount from your tax savings account is going to force 85% of your Social Security subject to an income tax. I'm assuming a $2,000 monthly benefit beginning at the age of 62, running to the age of mortality, 87, for both a husband and a wife, and in a 28% tax bracket. $272,000 is the calculated amount of the money on your Social Security you will give back to the government because you deferred your taxes. Not only will you owe the taxes at an agreed upon higher amount, you will pay in addition to that another $272,000 back to the United States government. Now, here's what I find fascinating. Fiduciaries are not required by law to explain any of that to you. Fiduciaries are required by law to discuss commissions, annual management fees, 12b1 expenses, and any conflict of interest that they may have. Well, if the number one reason why people with wealth, when they go to retire, have less wealth, it's because of something that many people just hide behind. I don't have to tell you how taxes work. There is a Fortune 5 insurance company that will not allow their agents to talk about how taxes work unless they're a CPA. There is one of the largest money managers in this country that forbids their registered reps, who are fiduciaries, to talk about taxes unless they are a certified public accountant. Well, think about that for a minute. If I'm building an account, and if I had the option, which I don't, but if I put all of your money into a deferred plan, and you follow typical financial advice and you pay your home off, therefore you have no deductions, and your only income is coming from a qualified retirement plan. If the tax rate should go to 90 the day before you retire, you cannot sue your financial advisor for misinformation. I'm not required by law to talk about taxes. You should have talked about this with your tax preparer. Your tax preparer is paid to lower your current bill, so you feel good about giving him that $400 bill so that you can file your taxes. See, I saved you money on your taxes. No, you didn't. All you did was postpone the inevitable. You didn't save a dime. So think about this. If we know what the end game looks like, and we all agree that we believe income tax rates are going to be higher than what they are today, next time you go speak to someone about how deferred plans work, would you please talk about an exit strategy? What I find fascinating is that we in the financial services business are allowed to say verbally, when you retire, you're going to be in a lower tax bracket. Who cares? You'll be paying less taxes. I got to tell you, people, the only way that you can pay less taxes is to have less income. Who in retirement wants less income? In 50 years, I have never, in an anniversary review with a client, had a bullet point agenda item that said, please make sure I retire broke. Or for that matter, even said, please, when I retire, make sure I'm in a 30% less tax bracket. Every client I have wants to succeed. Yet every bit of financial advice the financial services industry teaches is putting those exact same people in harm's way because they could very well owe more than what they've saved. And you can't sue me because I'm not an accountant. I'm not required by law to explain that. We have a whole group of people whose only job is to go out and explain the implications of the financial choices people already make every single day. And we use this analogy. Here's where you are, and here's what's going to happen to you. Do you know that when you retire, you're paid seventh? Seventh. Hold on. And there's a bunch of people and a bunch of entities that are going to get paid before you. You could be seventh in line, simply depending upon the city you live in. The city you live in. And if that bothers you, then shouldn't we have a conversation about the end game first? If we know what the end looks like, shouldn't I have the privilege of talking to you about how that's going to affect you? So here's where you are. Here's what's going to happen. Do you realize what's going to happen? My job is to make you understand what's going to happen to you. My job is not to tell you you're doing it wrong. My job isn't to give you any advice yet. My job is simply to say, here's what you're doing with your money. Would you borrow money from me if I didn't tell you what the rate was going to be? Every time. The answer is heck no. Yet when I look at your net worth statement, you have $1 million in an account. You don't even know what you owe. Now, does that bother you? It bothers me, and I'm not you. So when you start looking at the effect of what you've already done, there's a real good chance you might change what you're doing. Because here's what we teach our clients: to do it this way, because the effect is you could possibly not even have to file a tax return. If you understood what it is that I already know, you could build an account that's off the radar screen of the IRS for income tax purposes using the 6 parts of the Internal Revenue Code that use the word exempt, where distributions have absolutely no place to put on a tax return. And if we're not allowed to talk about the end game first, all I'm going to do is talk to you about 5 is better than 4. 4 is better than 3. And 3 is much better than a negative 20. Well, if I can keep you focused on something irrelevant, rate of return on net worth has very little impact on your net worth. Where your money is, real estate, collateralized accounts, foundation accounts, using the code where you can build wealth and manage it so that you're getting advantages from the wealth, that's how we build wealth. Think about that for a minute. My son was telling me about a guy that posted on Facebook to somebody here in Nashville and said, I have $10,000. Where should I invest it? And the response was pretty simple. He said, you should take $10,000 and go buy yourself a business coach so that you never ask that question again. Think about it. What are you going to get? 6% return on 10 grand? Ooh, that's a lot of money right there. Ooh, $600. Wow. Wow. And you're still going to be chasing rates of returns, not understanding the implications of the choices that you're making financially, build accounts that you have no idea what you owe, be debt-free in retirement, and pay the worst tax possible because typical financial planning was followed. If you knew what the end looked like, you probably wouldn't continue doing what you're doing. So the purpose of this meeting is to just simply help everyone on the call here to understand what our responsibility is in the financial services world. We need to help educate people on the most powerful financial product in the world. It is the most misunderstood product owned. It's the most misunderstood product sold. And it's the most beneficial financial product you could own. There was, my son had an appointment this morning and the guy says, you know, well, what about inflation? And Matt said, well, what do you think a good place for inflation would be? Hard assets. That's right. Gold, real estate, hard assets. Because that's how inflation works. And you know what else? Debt. Debt. Today, you can borrow $1 at $2.15. 2.15 on a 15-year note. And by the way, if I was stupid enough to sit down with a checkbook and write 15 years of checks, all I did was just change the date to 1 month in succession, and I have 180 checks right here. Which check is worth today's dollar? Today's check or the one that's dated 15 years from now? Not only are you going to be able to use the bank's money, they're going to let you pay it back on a discount. Hello? Why aren't we doing this? Oh, debt's bad. Okay. I've never met a wealthy person that doesn't understand debt. Never. And they have a lot. And they use other people's money. They don't use their own. And if they do use their own, it's simply to collateralize something else. And they live off other people's money. There was a recent article a week and a half ago where you got Bezos and you got Musk and you had Warren Buffett's tax return exposed. Somebody should be hung with that. But it shows no income tax. Why do you think that is, people? Why do you think the wealthy don't pay enough income tax? Because they don't structure retirement in the form of income. They don't have income. They have capital gains, they have dividends, they have collateralized money, they use margin accounts, they use mortgages. They don't spend their money. And that's not illegal. I firmly believe there are no loopholes in the United States tax code, but there are places in the tax code that benefit those people that will listen. Do you want to listen? If I could put you in a position where you're not filing a tax return using the rules by the federal government on collateral, would you give me 30 minutes of your time? If I could show you that where your money is so much more important than what it could potentially earn, will you let me talk to you for 10 minutes? If everything you're doing turns out to put you in a position worse than you thought, would you like to know now, or do you want to wait till it's panic time? See, all of these are questions that I look forward to asking someone when I meet them for the first time, because not only do I want to become a person of interest, I want to bring value to a conversation. And if I can simply share with you some of the average pitfalls that people have no idea what they're doing, and just simply expose the light for these people in a different manner, where we are now looking at the effect of what I've been told I should be doing isn't what I thought. Will you give me 30 minutes? See, to me, how to become a person of interest is not to sit in front of somebody and say, you're doing it wrong. My job when I meet someone for the first time is twofold. I want to create enough interest in conversation where the person asks me, what do you do for a living? And the minute that happens, I own the rest of the conversation. I know exactly how it's going to end up. I know where I'm going to be going. And as I start talking about some of the pitfalls that are associated with typical financial planning, once I catch their interest, my next job is to simply say, if we could help you achieve what you want financially, that is outside the 9 dots of typical financial planning, would you like to see how we work? As of this morning, I have $1,521 million of clients' money that has not lost a nickel in any stock market correction, guaranteed to be worth more every single year, month for that matter, and none of it will be subject to a federal income tax. How much money has your accountant told you that you could put away that would never be subject to an income tax? Here, let me help you with the answer. None. And if it bothers you that the current financial plan you're on will in fact put you in harm's way, does that even matter? Because if it doesn't matter, I have nothing to offer you. Many people on this call know that I sat next to a billionaire on a flight from Nashville to Dallas, and we started talking about taxes, and she looked at me and she said, what if we don't mind paying them? After throwing up on myself, I looked at her and said, we're just not a good fit. See, my job is not to convince anyone to do anything. My job is to simply help you understand, do you have a clue where you're going? Quite frankly, you have your foot on the accelerator pedal and you're going off a cliff. And I'm offering you a brand new set of brake shoes, and you're refusing to take them. I am going to watch this train wreck, but I cannot help you. Goodbye. And it's not that I'm vindictive. It's not that I'm mean. It's not that I'm insulting. It's just I refuse to chase people anymore. If someone doesn't understand that where they are is not going to end up where they thought, my job is not to convince them. My job is to ask them, tell me what your exit strategy is. And I cannot tell you how many times when I ask that question, I hear from the person, I have never asked that question of my financial advisor. And I look at them and I say, don't you think that's an important question that you should be asking? So my point of telling you that I don't have to, I'm allowed to tell you you're going to retire in a lower tax bracket. I find it hysterical that I am forbidden to put that in writing on my stationery, dated with my broker-dealer information on it. I will not be covered for errors and omissions. Why? Because I have no idea what the tax rate is going to be on the day that you retire. But I am allowed to tell you, you're going to be in a lower bracket, because that's how every 401k wholesaler goes around the country and tells you how retirement plans work. You're going to be in a lower tax bracket when you retire. Really? Can you put that in writing for me? I love asking this question of a certified public accountant. Would you borrow money from me if you didn't know what the rate was going to be? And of course, it's no. And then I asked them, what if you were to find out that you are doing that exact same thing for every client you have, and you are charging them a fee to force them to do that? Would that bother you? And if they go, no, then see ya. I'm not, my job is not to convince you. My job is just ask, does it matter? Do you care? So think about this. The whole premise for today was to simply, let's talk about what no one really talks about, and that's the income tax issue. The income tax issue is the problem. It's not the rate of return. If the taxes go from 37 to 72, what did 8% do over 6? Nothing. You increased your tax bill 100%. But I, as a fiduciary, am not required by law to explain that to you. Go talk to your accountant. I find that hysterical. My mission in life is to talk to every American taxpayer the truth about how wealth works. If asked, I'll give an opinion, but I don't give recommendations anymore. I don't suggest, I don't prove, I don't do spreadsheets. I just simply ask questions. If you knew what you were doing will provide a result exactly the opposite of what you thought, does it matter? Think about that. If that person says yes, you know what you have right now then? Permission to dig into their knickers. If you start off by saying you're doing it wrong and I can prove it, yeah, you can, but you've offended me. I will not listen to the rest of the story. Advice is given in one of two circumstances: when it is life-threatening or when I ask for it. Your opinion is irrelevant to me, but you sure as heck can ask the right questions to get me to think about what I am doing with my own plan. I think that is a much better way of communicating with someone than simply saying you're doing it wrong. All right, I'm going to open this up to questions. That was a 20-minute rant. By the way, David, we're gonna put this on the interweb somehow, and get this out. But that's my Steve Russell. That's my opinion, and it should be yours. All right, open to questions.